Brand new developments suggest the 2023 banking collapse in the US is not over, and it's going to explode in 2024 all over again. In the past 2 years, the US financial system has witnessed shattering events like the collapse of FTX, leading to absolute bloodbath on the crypto market, and ridiculous interest rates, which has left the ordinary person priced out of their lives. But not surprisingly, that's not all the evidence we have, as there's far more muck than meets the eye here. At first glance, the indicators in the US seem promising. Wages across various sectors rose slightly, for instance, but a deeper analysis reveals a more concerning picture. Even though wages have been increasing, the real disposable income, which is the income available to people after accounting for taxes and inflation, has seen a severe decline, and it's only getting worse. This discrepancy means that whilst on paper people might be earning more, their actual spending power is diminishing every day. Inflation is consistently underreported, leading to a widening gap between nominal wages and real income, even if the government claim it's all okay. This reduction in real disposable income has had a cascading effect on consumer behavior. One of the most evident indicators of this change is the decline in consumer savings. A decrease in savings usually shows reduced financial security for individuals, leading to decreased spending in the broader economy. Where people save less, they also tend to spend less, especially on non-essential items. And let's not forget that the overall global financial landscape is still riddled with uncertainties, and even the major financial institutions are not exempt from these challenges. JP Morgan has recently been embroiled in significant legal settlements. These high-profile legal entanglements can erode trust in the financial system, leading to diminished consumer confidence, and when consumers lose faith in the stability of major institutions, they tend to adopt more conservative spending habits, which ripple through the economy. And JP Morgan has just had to settle lawsuits related to the Epstein case, proving their guilt. Such settlements, especially when associated with these high-profile cases, cast awful shadows over the bank's reputation, making customers more wary of the financial sector at large. And other indicators suggest that consumers are feeling the pinch of economic challenges. Reports from JP Morgan Asset Management indicate that consumers are grappling with the lingering effects of reduced fiscal stimulus and heightened inflation, which has led to a depletion of their savings and an increased reliance on debt. Such trends will have far-reaching implications for the US economy, impacting diverse sectors from retail to housing. In essence, the combination of legal challenges faced by major banks, market uncertainty, and the shifting consumer financial behavior paints a near-certain indication of another financial bloodbath. As these factors converge, they beg and scream the need for both financial institutions and policymakers to remain vigilant and proactive in navigating these challenges before the common man is pushed under the bus again. But a practical example of this reduced spending can actually be observed in the performance of discount retailers like Dollar General. Historically, discount retailers have thrived during economic downturn. Consumers become more price conscious about spending habits, but recently, data paints a different picture for the current economic climate. In the second quarter of fiscal year 2023, Dollar General saw their increase of sales by 3.9%, but from the last financial year, they saw their operating profit decrease significantly by 24%, and they cut their forecast for the next year as well. This downward revision in sales growth expectations, coupled with the decline in operating profit, suggests that consumers are not just looking for discounts, but are genuinely cutting back on spending. The fact that even in a challenging economic environment, consumers are cutting back on spending, even at discount scores, underscores the depth of financial concerns many are grappling with. But that's not the end. The final nail in the coffin came when recently several prominent institutions, including Citizens Financial, Fifth Third Bancorp, M&T Bank, KeyCorp, Huntington Bancshares, but that's not the end, as the final nail in the coffin came when several prominent institutions all received financial warnings. The Fed issued numerous private warnings to a bunch of banks, stating that they are genuinely worried about what might come next should the economy continue to decline. Following a series of bank failures, there have been calls for lenders to improve metrics and address technological flaws, emphasizing the need for robust financial infrastructures. But some have even faced downgrades from the Fed, which can have cascading effects, affecting investor confidence and potentially leading to reduced lending throughout the ecosystem. And let's not forget how the bank runs of 2023 actually started after all. In light of these developments, it's evident that the warnings received by these institutions are not isolated incidents, but part of a broader trend, including potential instability in the economy. This financial turbulence, in turn, has repercussions down the value chain, most notably in the labor market. Labor markets and the financial system have been closely intertwined since the dawn of the modern world, and today, both are under tremendous tension. The labor market has witnessed significant shifts, with indications that the self-sustaining job market that emerged during the pandemic is now over. This isn't merely a short-term effect of the pandemic, it's anticipated to persist for several years, hinting at several deeper structural challenges. A key factor of influence is the impact of interest rates. For families not reliant on borrowing, the increasing rates might seem distant. But for those dependent on loans, the escalating rates are starting to tighten their financial belts. This has repercussions for overall consumer spending and borrowing, which subsequently affects job opportunities and the broader labor market. On top of that, global economic indicators add fuel to the fire too. Recent patterns suggest a downturn in stock futures that will only get worse. If businesses adopt a more cautious stance due to this uncertainty, it could result in more reserve hiring and investment choices, further straining the labor market. 5 of the biggest banks in the world have quietly laid off 20,000 people so far this year. It's alarming, but you shouldn't be surprised. The time to get ready was months ago, because nobody, I repeat, nobody has an optimistic outlook for 2024. Interest rates are wearing down the global economy. Defaults on corporate and consumer loans are surging, and no matter your preferred investment, chances are it's seeing historically low numbers. So if you're not diversifying your assets, get used to low gains. And I'm not talking about diversifying with individual stocks or with mutual funds. You need assets that won't immediately become worthless the next time there's bad news. And that's exactly why new UBS data revealed millionaire and billionaire investors are allocating between 30 to 50% of their portfolios to alternative physical assets like fine art. And you can do that too directly from your phone, thanks to our sponsors at Masterworks. Masterworks have already generated over $45 million in art sales and distributed the returns to investors like you who don't have multi-million-dollar portfolio or art scene connection. They've had 16 exits so far, and each of them delivered positive returns to their investors. Over 850,000 people have joined the platform thus far, including thousands from this channel, and offerings have sold out within hours. But my subscribers can skip that waitlist and start collecting today by clicking the special link in my description. I've invested too because I really think it's a great opportunity, but of course past performance is not indicative of future returns. The relationship between private banks and the Federal Reserve has taken a concerning turn. In a bid to maintain liquidity, private banks have been increasingly lending bonds to the Federal Reserve in exchange for cash. This trend, driven by high interest rates and a decline in deposits, is a clear indication of a liquidity crunch looming on the horizon. When banks see a reduction in their deposits, it directly impacts their capital reserves, which in turn affects their ability to lend out. This leads to a slowdown in both commercial and consumer lending, which ripples out into the economy. Since March 2022, the Federal Reserve has raised interest rates more than 10 times, with the federal funds rate currently set at well above 5%. Such a high rate is a stark shift from the easy money stance that was prevalent for the last 15 years, when interest rates were at zero was the norm. And with the Fed reversing its policy of QE as well, liquidity in the markets is only going to get tighter. As the Federal Reserve reverses its policy of QE, that involves purchases of Treasury and mortgage-backed securities aimed at providing more liquidity to capital markets. In essence, this going backwards means the dynamics between private banks and the Federal Reserve, coupled with the broader monetary policies, paint a picture of an economy grappling with both liquidity problems and inflation. And the sad truth is, there's no easy way out for the economy. The looming wall of corporate debt has become a significant point of concern for analysts and economists alike. As companies have been taking advantage of historically low interest rates to borrow heavily, there are growing apprehensions about their ability to service this debt, especially in the face of deteriorating economic conditions. Fidelity International's Salman Ahmed has been vocal about his concerns regarding this issue. He states that the US economy is heading for a recession, even as many on Wall Street are optimistic that the Fed has successfully steered the US economy towards a soft landing. His primary concern stems from the impending wave of corporate debt refinancing expected over the next 6 months. He predicts that the culmination of this cycle will be a recession as the transmission channel of monetary policy tightening begins to manifest its effects. Ahmed's concerns are not unfounded at all. After enjoying the benefits of easy money during the pandemic, corporations are now faced with a significant amount of debt maturing in a new era characterized by high interest rates. The delayed effects of the central bank's tightening measures are anticipated to be the final push that sends the economy into a downturn. Ahmed points out that companies that previously financed themselves at rates of 2% might soon find themselves facing financing rates of 12%, a shock that could have severe implications for their financial health. And Ahmed's predictions are unfortunately further supported by a study from a group of Federal Reserve officials. This study indicates that it typically takes about a year for companies to feel the full effects of interest rate hikes that have already been implemented down the line, and that's irrespective of any future rate increases. Fidelity's message is simple: brace for the expected wave of refinances in early 2024. The global financial system, with an estimated value of $60 trillion, is currently teetering on the edge of significant disruption. Several factors within this vast system, potentially overlapped or exposed to high-risk assets, are showing signs of strain, which could precipitate widespread financial instability. A clear manifestation of this instability is evident in the corporate debt landscape. Analysts have been sounding the alarm bells about a potential recession in 2024, driven by a looming wall of corporate debt. As companies have capitalized on historically low interest rates to amass significant debt, concerns are mounting about their capacity to service this debt, especially if economic conditions take a turn for the worse. The glue that binds both local and global economies is at a critical crossroads. The United States, grappling with banking dilemmas, intricate monetary struggles, and looming corporate debt, is steering through a storm of economic uncertainties. While the Federal Reserve's interventions aim to anchor the economy, their ripple effects touch every corner of the world, influencing businesses and individuals alike and thrusting us all into the arms of total and complete chaos.